Good afternoon, everyone, and welcome to today's online roundtable hosted by REFIRE and Targa Communications. Today's discussion is focused on the retail market and asks, is 2022 the time to go shopping for retail assets? My name is Andrew Barber. I am Managing Director of Targa Communications in London. Over the past 2 years, the retail market has been one of the hardest hit sectors during the COVID-19 pandemic. Operators have hit by social restrictions, including lockdowns and curfews. Responding to the crisis, investors in retail real estate assets have had to realign their strategies. Today's roundtable discussion is taking a look at the factors shaping the retail sector in 2022 and asking, is it now the right time to invest in this dynamic market? Where will investors find value and how will opportunities vary across local, regional and national markets? What is the impact of e-commerce on the market? What are the ESG considerations for investors in the retail asset class? What does the future look like for our town centres, city centres and out-of-town shopping destinations? In order to address these and other questions, we have today assembled a panel of experts to analyse and discuss the topic. We are joined by Yoki, who is Head of Retail Investment Services in Germany for Savills. Our second guest is Brian Morris, who is Managing Director and Head of Investments EU for Slates Asset Management. And last but not least, we're joined today by Marlene Tavar, who is Head of Retail Logistics Investment for JLL and joins us today from Lisbon in Portugal. Once again, our lead moderator for the roundtable is Charles Kingston, who is CEO of REFIRE magazine, which is recognised as the leading source of information on German real estate finance for institutional and international investors. I'd like to extend a warm welcome to our panellists and to everyone joining us today, and I will hand over to Charles to lead to today's discussion.
Thank you very much indeed, Andrew. I'm Charles Kingston. I'm the chief editor and the publisher of REFIRE, Real Estate Finance Intelligence Report Europe. And I'm very glad to welcome you all this afternoon. We have a very interesting panel of retail experts. The tone, obviously, given the panelists that we have, is very much more European in nature today, because we can cover a number of grounds and a number of trends that are becoming apparent in most of the major European markets. Now, normally in a presentation like this, we sometimes have an impulse speaker giving a 2 or 3 minute little introduction to some of the key statistics. This afternoon, I am myself just going to run through. We have the privilege of a number of charts from Savills in this case, to show you some of the key trends that will underlie most of the discussion that will follow. I'll just make a brief comment on them, and we can use that as a basis for the discussion as we go on. Okay, I'm unable to see that particular chart.
If you want me to, Charles, I can
I was going
jump
to say,
in.
you know this better than me.
Summary of
That's
chart.
fine. To have a couple of words on that, and then we can carry on with the discussion.
Yeah.
Go ahead, Jörg, please.
The chart is basically about the entire transaction volume. Obviously, dropped in 2021, and what was crucial was that shopping center investments went down to only 12% of the entire transaction volume. However, the convenience sector has clearly seen an unprecedented volume, and it would have seen more if there would have been more product in the entire market. And this accounts for almost 50% of the entire transaction. Retail transactions, which were approximately around 30 billion euros across Europe. So something very obvious, probably for the entire audience. The flavor of the month and the flavor of the past years is clearly convenience retail, and investors are still demanding this on very, very low yields, which we haven't seen at any stage of the entire cycle before.
Good. Go ahead, Jörg.
Yeah, this chart shows the increase of supermarkets and hypermarkets investment overall. And this has obviously gone up in until the third quarter of 2021 to more than 3 billion euros. Compared to 2020, it was lower, but all across the countries, clearly this sector was in the majority of the investment.
And the key figure there is the tripling, in fact, of the share of supermarkets and hypermarkets in total retail investment in the space of a couple of years. Quite an astonishing move upwards. Go ahead, Jörg.
Sorry,
no.
If you can see it right now,
yeah.
I'm happy to listen to your interpretation.
No, that's fine. It's coming in now. No problem. Sorry about that little minor technical glitch. Yes, this just shows exactly how, after a couple of strong years of investment into the supermarket sector, we're seeing considerable yield compression. And we'd like to examine whether, how sustainable that is, given this performance over the last couple of years and increasing competition into the sector. Felix, next chart. Again, one of the main attractions of the supermarket and Fachmarktzentrum sector has been the defensive characteristics of it, and how there has been a considerable shift in investment activity from other classical retail investments into the sector over the last couple of years. Again, signs of hardening in yields for retail parks. It's a separate segment. We'll be talking about that later on as a complementary asset class to the Fachmarktzentrum or to the grocery anchored retail. This chart shows clearer than any other chart how even before the pandemic, shopping center investment was dropping significantly, and that the challenges being presented by online commerce, e-commerce, were already becoming apparent and making it so difficult for the retail sector, perhaps accelerated then, of course, by the COVID pandemic. But the chart shows you the direction of travel for the last 6 or 7 years, quite extraordinary. Again, shopping center yields moving out. We will be looking at how some of these assets will be trying to shift their actual makeup within themselves, the tenant mix, to include new segments of commerce which were not traditionally associated with shopping centers. And again, the final chart here just shows the extent to which universally the e-commerce penetration is rising throughout the markets. We can see, interestingly enough, and Marlene will be able to tell us a little bit more about this, how particularly in the Mediterranean countries, perhaps the degree of e-commerce has not extended to the level that it has in the colder Northern European countries, which are really quite significant. But we'll be having a little look at that later. I think that's the final chart. Is that right? Yeah. Great. Andrew, if I may just also ask our three panelists to just in very briefly introduce themselves, tell our audience what it is that they do, what their key interests are, their key activities are, so that when we discuss things, the audience will know more or less where our speakers are coming from. Marlene, perhaps I'd ask you first to just say a few words about yourself and your position.
Thank you, Charles, and good afternoon to everyone that is listening and present in the session today. My name is Marlene Tavar. I work for JLL. I'm based in Portugal. I had the retail and logistics investment team within the capital markets team, and we cover all the investment transactions into retail, which include shopping center transactions, retail parks, high streets, standalone, and also new formats of retail, such as the dark stores. I've been working in JLL for 5 years now within the capital markets team. I'm also part within the capital markets team of the Southern Cluster, That includes Portugal, Spain, and Italy. So I'm here present to try to give a little bit of flavor of the retail markets in the south of Europe.
Excellent. And we're very lucky to have that extra perspective this afternoon, Marlene. Thank you very much. Brian, can you say a couple of words about yourself and about Slate Asset Management?
Sure. Hi, Charles. Hello, everybody. Good afternoon. My name is Brian Morris. Like Charles, I'm Irish. I'm a managing director in Slate Asset Management. Slate are a global alternatives investor in real assets. As it pertains to my own role, I help support our teams in Germany, Norway, UK, Ireland. We are Slate. One of Slate's strategies is to invest in essential real estate. That's been one of our focuses in Europe since we've been investing here. So we currently have assets in Germany, Norway, UK, Austria, Slovakia, and Ireland. Yeah.
Thanks very much, Brian. Just explain to our audience what Slate understands by essential real estate.
Yeah, sure. So essential real estate, we've been investing this really for 10 to 15 years globally. We're originally Canadian. So when we think about essential real estate, we're really thinking about that, grocery, DIY, medical services, any type of real estate that ultimately stayed open, operated and paid rent during the pandemic. It usually performs good, performs in good times as well as bad. So that's really what we think about when we think about essential real estate. So need-driven real estate. Yeah.
Need-driven real estate. Excellent. And Jörg, tell us a little bit about yourself and what you do.
Good afternoon, everybody. I'm Yoki. I'm basically leading the German retail investment services team, and I'm a member of a European group which is focusing on urban repurposing and retail repurposing, and it's one of our focus in Germany as well. That means we are converting shopping centers into something which is feasible and sustainable for the future. We are converting department stores, and obviously, as you might have seen by my colleague Marlene, she is the head of retail and logistics. This is some kind of sectors which are merging currently together and will merge in the future together. So under this umbrella of repurposing, we are having a lot of sectors, not only logistics, but residential, medical office, gastronomy, logistics as well. And we try to help our clients to make the best out of their retail real estate.
Excellent, excellent. Well, I was reminded earlier on that in fact it is a year since we had a previous online discussion on retail, and at that stage, after 1 year of the pandemic, of course, there were various people that had backgrounds, and yours, Jörg, was very much a gloomy, doom-driven scenario of a downtown shopping center. I'm very glad to see that it looks a little brighter now. But one of the things, just before we start this discussion, a year on, and what we have seen in the last couple of quarters across most of Europe has been a certain thawing, certainly a sense of growing optimism, if I may say so. Given that the title of this afternoon's discussion is 2022 the time to go shopping for retail assets, perhaps you might, all three of you, just weigh in, throw in your own ideas right now briefly as to whether you're feeling optimistic, pessimistic, neutral. What is your view on prospects for retail for this year? Jörg, while you're there, tell us.
Well, first of all, of course, it's always time to go shopping for retail. That's what investors like Slate, where investors like Slate give evidence. That's the easy part of the sector. It's the grocery anchored retail part and the entire convenience sector. However, it's a very expensive sector, and based on the rising prices and falling yields in that sector, we clearly see the opportunity for other asset classes in retail to become more liquid again. And this is shopping centers, bigger retail parks, big box orientated shopping centers, and of course the high street as well. As long as investors will see that there is some kind of future story for these kind of assets and a sustainable rent, which is obviously need to be come down to a post-COVID level to be sustainable. They would go for this asset class again. Hence, we expect a more dynamic market in this sector with some uncertainties, which are ESG, which is probably pulling investors away from some of the opportunities, and which will maybe cause some more capex, which need to be included in the pricing. And of course, we have a situation in Europe which is currently sustainable. This is the interest rates, but we expect them to rise as well. And this will, of course, have an impact on pricing.
All right, but you're sounding basically optimistic. Marlene, I know that in addition to your own responsibilities in Portugal, you also sit on JLL's Retail Committee Europe, which gives you obviously a broad overview. Now, while it's true we have yet ever to meet a broker who advises you not to buy, what are your views on the outlook for retail in all its various asset categories for the coming year? Is 2022 a good year for investors to be dipping their toe back into the retail market?
Charles, I definitely sit on the optimist side, which concerns to the retail sector. After years of turmoil in the sector, with retail having to adapt to various changes in consumer habits, we have learned that retail is very resilient, and it changes fast and adapts to quickly to the consumer habits. The pandemic also showed that retail is resistant. In specific asset classes, what we seen was rental growth and yield compression, and this will bring, of course, more opportunities to the sector. The 2021 was dominated by transactions on small or medium schemes in retail parks and also convenience stores, as York was mentioned. The best performance assets in 2021 were definitely supermarkets and also retail parks. And we will see in 2022 opportunities appearing in the subsectors and also other subsectors of retail that have been proven resilient. High street retail in prime location, or for example, in very high density residential areas. Everyone is searching for beauty and convenience when they do their shopping. So we see opportunities and the retail sector to perform better in 2022 than it did in 2021. And it was already a year that, in our view, was better than expected. We need to go back 1 year, and January, this time of the year, we were all in a very strict lockdown. And still, when we look to the performance of some retailers, it's not the full market that is performing well, but when we look to the performance of some retailers on do-it-yourself, sports, and of course food retail, there's strong fundamentals of a positive year.
Terrific. Many of those little reports, Brian, will probably be music to your ears. I know that Slate last year alone in Germany spent over 100 million. So you guys are not afraid to invest at the moment. Tell us about how you're looking at the market after 2021.
Yeah, I mean, it was a terrific year for Slate last year, 2021. It was a pivotal year up until last year. We'd been exclusively focused on Germany and on discount format grocery stores, where we've amassed over 300 assets, which we manage ourselves. But last year we went into Norway, Austria, Slovakia, and these other geographies. So we're very much expanding our geographical footprint in Europe, but also expanding not just into supermarkets, but into essential real estate, as I previously mentioned, and Marlene touched on DIY stores and pharmacies. That's the type of real estate that I'm after, and that Slate focuses on. but it's, you know, as I previously mentioned, they perform well in good times as well as bad. The tenants are extremely resilient. It's need-driven retail. And typically those covenants, they're led by very, very strong credits, like really, really strong tenants. And yeah, we enjoy the resiliency of the cash flow. We continue to expand in Europe, as I said, but with that particular focus. So we might necessarily be chasing down shopping center deals or high street deals. Primarily, it's more in that that essential real estate space. But to your point, last year was we did 1.5 billion euros worth of deals last year in that area alone in Europe, which is good. But as a result, you know, I think people have maybe copped on to the fact that supermarkets they've almost emerged as an asset class in their own right out of the retail space. And actually, when you think about it, and we think about it a lot, we're thinking, you know, our supermarkets, where does retail end and where does logistics begin? You know, when you think about even the physical layout of a discount format grocery store or any supermarket, it's more, it looks like and performs more like a logistics asset maybe than a retail asset. You know, 20 to 20 foot clear heights, loading bays, close into where people live, usually around, you know, centrally located in densely populated areas. So yeah, really those locations are extremely important. And we think about the hub and spoke models. We really need to be at the end of the spoke, you know, when ultimately we're distributing food and distributing essentials. So whether it's medicine, food, or other perishables, you need to be close into where those people and the end user uses that. So that's the type of real estate that we focus on. But Germany obviously has been our centerpiece, but we're moving out of that and trying to explore new markets. But as I said, there are more participants. Pricing has got tighter. There's, you know, because people like the resiliency of the cash flows. It's the lack of alternatives, low interest rate environment, and yeah, there's more players in the game and there's more capital available to deploy in that sector. So my job has probably got a little bit more difficult in terms of new acquisitions, but sitting relatively pretty on the, you know, the investments we've made today, touch wood.
I was about to say, your job must have become considerably more difficult. It's all very well to get to know one asset class which has done very well, and that in Germany over the last, since you guys have been in Europe, but you expanded into several other European markets last year. Was that, if I may ask you, was that as a result of your feeling that the segment that you had invested in was reaching the point of diminishing margin returns, or was it an attempt to expand your activities geographically to be less dependent on one geographic market? What was the thinking behind your strategy?
It's a very good question, Charles. I think it's probably a little bit of both, but I mean, ultimately we have a European lens. We don't just think about Germany. We've been tracking and mapping deals in Europe, across Europe, since 2013. You know, we're very, very diligent and disciplined about our approach, and we take our time. So we've been looking at deals in Norway probably for the last 5-6 years, but ultimately we've missed out. Same in Spain, same in Portugal. Our focus really from a geographical perspective has been on Germany, the Nordics, the UK, and maybe kind of secondarily Southern Europe. But yeah, there's no doubt pricing has increased in Germany. But look, Slate, we're opportunity driven. As I say, we've got, you know, people on the ground, and we've been looking at deals for a long time in those geographies. So we're driven by opportunity, and we like those geographies. So and obviously we want to expand our presence in Europe. So a bit of both, I would suggest, Charles.
Good. Jörg, would you agree that, or would your sentiments concur with Brian's that the yields on the grocery anchored retail are becoming less attractive?
Yes, I entirely agree. In some parts, I must admit, I don't really understand that situation. However, if I look at the capital pressure, which we try to estimate for this year, we believe that roughly 9 billion euros of capital want to be deployed in this sector, and we probably see only a transaction volume of 4 billion, and that means, of course, a further yield compression. What we expect is no good news for Brian at the end of the day. We believe that the yields in the commercial sectors of offices, logistics, and grocery-anchored retail will merge in the course of this year, somewhere around 3%. And as I said, I have always worked in the retail sector, and I've never seen this kind of situation. I'm coming from years where I was already in retail investment, where some developers were happy to achieve 7.5% or 8% when they were selling their retail warehouse. Having said that, I am of the opinion that the next big thing is where Brian is after as well. That's the DIY sector, because yields are higher, but they will compress as well. And I can only support that strategy, because this is basically the same thing as a Edeka or Kaufland anchored supermarket. It's more or less a bond which the investors are looking for and what they are buying. So DIY is the next big thing. And another sector where I believe we will see much more activity than before, I already mentioned it, is where investors see the opportunity to reconvert retail into something else. And this could be in the city centers, it could be in the district, and of course it will always be in the big city hubs we are having in Germany, in the top seven cities. And these 7 cities have the exception of Berlin and Munich, which is going crazy, or has gone crazy the past 3 years.
Okay, well, we'll talk about reconversion in a few minutes here, if we may. It's interesting, because it's clearly a very much a subject that is being talked about and thought about a lot by businesses. Marlene, in Southern Europe, is there the same attraction for the grocery anchored retail segment? Have you seen the same yield compression over the last number of years there, or investors expanding their range, people like Brian expanding their range to pick up underexploited assets in Southern Europe?
Definitely, Charles. Yield compression on grocery retail or food anchored retail has been significant in the past year. We had already bigger appetite from investors for this type of product, but it has boosted with the pandemic. We have seen 75 bips compression on prime grocery yields in the past 12-18 months. So we are reporting by end of 2021 5.25% prime yield for supermarkets, and back in 2019, prior to the pandemic, this was on 5.75. It is expected this yield compression to continue because we are attracting in the southern countries, and especially in Portugal, we are attracting capital because, as Jörg was complaining, there is a premium when you invest in Southern Europe, and especially in Portugal. So there's value to be created when you compare to the prime yields for supermarkets in German. There's almost 150 basis points different, and that is significant and attracts more core capital towards the South Europe. The biggest issue is the lack of available product and also volume, because as Brian was saying, in order to go and enter a new geography, you probably need a significant volume for your investment to buy a portfolio. We're not seeing that happening in the past years. I believe 2022 may bring some opportunities there as well, with some grocery operators starting to think of selling leasebacks. So definitely we will see some activity in grocery retail in Portugal with increase of investment volume and probably more yield compression.
Good. And for all three of you, is there a difference within your key markets? Is there a difference between, let's say, supermarkets on the edge of small towns or in cities? Is there geographical differences? Are there different ratings being applied to assets which are close to the city? Or, as has often been argued in the past, if you have supermarkets on the edges of small towns, you are not easily replaceable by the internet or by the lack of interest in heading into the downtown areas. Are there geographical differences? Is it a factor when you're looking at assets? Brian, maybe I'd start with you, because you guys have got 300 of these stores alone in Germany.
Yeah. That's a good.
You obviously think about these things a lot.
Yeah, I do. I think about in Germany, our focus, Charles, has been on the discount format grocery stores. So the Lidl's, Aldi's, Penny's, Netto's. That's the dominant one where we focus. And I mean, we like those footprints for a number of reasons. We think that that real estate is super important. The rent that they pay is super important. It's a very, very low margin business in grocery. We're well capitalized landlords. We really think about partnering with the tenant in terms of how can we make them become more competitive. Germany's a very, very efficient market from a grocery perspective. But in simple terms, again, we're super defensive when it comes to investing, and the backfill options that exist, if you've a 14,000 square foot store, I would argue there's more of them if you've a 70,000 square foot store, in terms of if that tenant should leave for whatever reason, filling it with a gym is an option, which we've done a number of times in Germany, where we've bought vacant stores. So yeah, I think it varies from country to country, and also about how consumers shop. So a German shop's very, very different to someone in the UK. The UK arguably is not as au fait with the discount format grocery store, but is more used to a Tesco or Sainsbury's that typically will be in the 50 to 80,000 square foot range. Will have a much larger number of products, etc. So yeah, we think about that, and ultimately we just think about what's replacement cost, what am I paying per square foot, what are the backfill options, and how important and integral is this piece of land to the community around it. That's really what we think about. And most importantly, is the tenant making money in that location off that rent?
And is he in most instances paying you? I understand you have a good track record of.
Well, yeah, I mean, look, during the pandemic, we were lucky in Germany. We were 100% current rent collections, which was fantastic. So I don't know, we were smart enough to be lucky, or lucky enough to be smart, one or the other. But we were 100% rent collected across the portfolio, which again just speaks to the resiliency and the defensive nature of grocery stores, particularly in the discount format space, particularly in Germany. So yeah.
Jörg, apart from the grocery anchored sector, this has not always been the case over the last couple of years in the shopping center market. Relevant to the Germans amongst us is the BGH, the Bundesgerichtshof decision last week, which allowed in principle a certain amount of rent to be discounted if they had to close due to COVID. But one of the things that seems to be apparent among most landlords is that these issues are largely resolving themselves now. The same question goes to you, Marlene. Have you reached? Do you believe you've reached a floor of the whole renegotiation that's going on between tenants and landlords in some of the more popular shopping centers? Jörg, I'll ask you that first, perhaps. Yeah, perhaps, and then Marlene might tell us the view from Southern Europe. But this has been an issue. Jörg.
Of course, throughout the entire COVID pandemic. However, the issues we're seeing in retail right now have been existing before, long before, and these haven't been resolved, not even by operators, not even by the retailers or the landlords. Right now, they have to resolve it, which is basically as I see it, a very positive thing, because the pressure is on, and everyone who is working in this sector has to take care of the future development of the assets, of the urban locations, of the district locations. However, the question is, have we seen already the basic line of rents falling? Clearly, in some sectors, we have seen that. Clearly, some sectors are benefiting from that situation, as Brian already highlighted. I believe food sector was the turnover was up to almost 20% or so in the past few years. So, however, the textile sector is clearly affected by that situation, and in that sector, we haven't seen the bottom line yet.
Okay, Marlene, are you seeing something approximating a red line, a line in the sand between existing tenants and their negotiations with landlords? In other words, for investors, without clarity, it is very difficult to invest in something, and if they don't know what they're going to get, they're going to put a big distance between themselves and the asset. What are you seeing happening there?
Yeah. Yes, Charles. For shopping centers, what we see for 2022 is more on the neutral outlook. The situation for a shopping center is a bit more complex. Of course, the pandemic intensified a little bit what was already an issue and a need for shopping centers to adjust to the new trends of retail. There is some revival on the performance of the shopping centers in Southern Europe. Post-lockdown, we already seeing some recovery of sale levels, of footfall, and this will bring some clarity on the operational income and on pricing. With the relationship between tenants and landlords on shopping centers, rents and incentives are an issue because they impact directly the NOI of shopping centers. But the way I see it is that for shopping centers, we will need to have a transition on the relationship between landlords and tenants. Tenants will need to put much more efforts into their stores to create formats and experience that can attract visitors. And also landlords will need to invest in their shopping centers in order to have that appeal that will make people want to return to shopping centers to the levels we had when first shopping centers appeared in our market, and of course on the peak of 2017 and 2018. We will definitely continue to see during 2022 retailers wanted to have more incentives in order to support their recovery, especially in Portugal, for example, where shopping centers were closed 4 months into 2020, another 4 months in 2021, and with additional governmental impositions in terms of discounting rents. We will need, at least in my view, 12 months of shopping centers operating to the full, so the investment market to gain the confidence to go again and buy shopping centers, because there's equity available to buy shopping centers. But as you mentioned, clarity is super important, and also some confidence that the resilience of shopping center is there.
Our office here in Berlin, where I'm sitting right now, is the Schlossstraße in Steglitz, which is the third busiest shopping street in Berlin, after, I think, the Kurfürstendamm area and Alexanderplatz. The Steglitz Schlossstraße has long been considered an overshopped area, but it attracts a great deal of buyers, consumers. Now, the second major shopping center has just been sold there. It was a widely publicized deal in Germany. The Boulevard Berlin, which is a huge, big center, anyone who'd ever been in there in the last 5 years could see that people must be losing money hand over fist here because there were simply too many vacancies. Now, they have sold it. Maybe Jörg knows something about this deal, but the question I'm putting to you is, these are people, this is one of the first major shopping center deals that we've seen. We don't have full price visibility on it, but at least it indicates that people are accepting the fact that they may have to write off significant sunk costs. In this case, Klépierre. I think they bought it 5 or 6 years ago for about 375 million, and the new buyers have said specifically they paid a considerably less for that. Do you know anything about this, Jörg? And are we likely to see more of these deals coming up in 2022?
First of all, and very simple, yes. Actually, we have seen more. Yes. And we've seen more of these kind of value add deals throughout the past 2 years. And even bigger shopping centers, but not in this kind of prominent location. This Boulevard Berlin was a shopping center, which was the last one, obviously, completed in that area, and it was basically one nobody needed at all, as it was already overshot via 3 shopping centers. Hence, the situation they were facing not right now over all these years was quite clear. It was clearly distressed, and I would say this is a typical Berlin deal, because the investors, Damen Capital, and some others will cut this shopping center down, and will have remaining retail only on the ground floor and put offices on the upper floors. I think further 4 floors with offices. I'm not trying to indicate this is simple, because pricing has to come down to a certain level to support another investor coming in and investing in that piece of real estate.
Brian, I know that given your strategy of investing in necessity only goods for the daily use and so on, are you coming across beaten down assets, or assets that would last year have been at a price at a higher level, and that because you come in strongly capitalized, you can buy it at super attractive prices? Or is that not the case?
No, I just say that is the case, Charles. But that's not the case. No, not. For example, like shopping centers, unless they were, unless maybe 50% or 60% of the income was coming from grocery, pharmacy, dental service, whatever, it wouldn't pique our interest at the moment. That's not to say you can't make money in those assets. You can if you buy them correctly. But they're going to need a lot of capitalization, a lot of repurposing, and ultimately, yeah. Go ahead.
Is not something you're going to do yourself. You're going to be looking for the assets that are already repurposed, perhaps. Is that right? That's not an area of focus for us at the moment in Europe. Yeah. At the moment. It does raise the whole subject of repurposing. It's going to, and Marlene, I'm sure you're seeing a lot of this too. It's surely going to play a major role in repositioning many of these assets, the shopping center assets, and we're starting to see that now. One of them just around the corner here has already slashed its entire height from 5 floors to 2 floors, with the rest of it upstairs being leased out to offices and data centers and gyms and so on, but mainly offices. That's a trend that you're seeing also in Southern Europe?
Correct, Charles. We need to separate shopping center into 2, those prime and dominant that perform well and will always have space in the markets, and will continue to be sought after by investors. And on the other hand, the secondary or tertiary shopping centers underperforming, investors are starting to look to those assets for repositioning. We have already good examples, implemented business plans of shopping centers in Lisbon in Portugal, that were reconverted to private hospital. Also around Lisbon, shopping center reconverted to a private school, and all of these business cases are successful. We within JLL, we have of course the reshaping retail services, where we present solutions for our clients to reposition the shopping centers into co-work facilities, senior houses, depending what the specific municipality allows for that location, and what, of course, the catchment area needs and asks.
Good, very good.
And just
Andrew, I'm
this,
going to ask you. Sorry, Marlene. Did you want to say something there?
Just the final comments on the pricing of those on this underperforming assets. What we've been seeing is investors are willing to do this repurposing and buy shopping centers and reconvert it to a different use, but with significant discounts on pricing. And price discounts in this type of assets, what we've been seeing mainly in Portugal, is in the range of the 25%, which is significant.
And are you seeing an increased acceptance among landlords to accept the fact that they're going to have to bite the bullet and devalue or revalue downwards the value of the asset, or are they still hanging on in anticipation that there may be some turnaround?
Yeah, I think we are still on the first phase of the reconversion of shopping centers, where the assets we are seeing being transacted are owned by the bank, so they are already non-performing loans,
Right.
and so the lenders are willing to do this transaction with, of course, discounts on the asset value, but take out the shopping center from their balance sheet.
Right. So some form of a bottom is forming. You're
Correct.
That's very good. Andrew, back to you. Do you have we got questions coming in?
Yeah, we've got some questions. I'll fire one. It's from Tristan Frost, who asks, what is the percentage of vacancy in high streets across Europe, and how do these rates compare to the historic average? I don't know if anyone has got any facts at their fingertips, but I've certainly noticed locally to me a lot of vacant shops, whether they are no longer income producing, maybe they're having a rest, I don't know, but there's certainly been a marked increase in empty shops in my area.
Can you just repeat the question again, Andrew?
Yeah. What is the percentage of vacancy in high streets across Europe, and how do these rates compare with the historic average? I don't know if anyone's got a view on that.
It might be a bit unfair to ask our panelists such a question.
Maybe they have some anecdotes. You're laughing at me.
Yeah, because I'm absolutely not prepared for this question.
Okay.
I need to guess.
Nobody should be carrying that information around in their head anyway.
Clearly, I think that first of all, the high streets are shrinking on the various ends. That's clear for us, and they would be converted or changed into something different than that. That's clear. I would guess it's around 10%, but that's really only a guess. I need to check with my research guys.
And if I can throw something in, yeah, and Yoki, if I can throw something in, Andrew, in answer to Tristan Frost's question, well, I don't have any of the statistics in my head either. I do know that one of the bright lights for the local retail brokers has been, in fact, the springing up in the last couple of years in any vacant retail space close to the city centre of a market which didn't even exist a couple of years ago, of the 30-minute delivery companies in Germany, Gorillas, Flink, right. Several of them, all racing around town on their bikes or on their scooters, delivering groceries within 30 minutes, and an entire new subsector which didn't exist a few years ago.
Yeah.
So I don't know what the percentage of those new stores are that become vacant and suddenly turn into a dark supermarket or something, but it's considerable, and you can see them visibly all over town.
Yeah.
The only comment I'd throw in a comment, Charles, about
please, Brian.
If you think about, the high street, particularly in the main city cores, have been for the last 2 years have been pretty much hollowed out, with two connected things, obviously the pandemic, and then secondly, people working from home. So the lack of office workers, in around the high street, some of them are very reliant on office workers, whether they be restaurants, shirt companies, tailors, that type of thing. We've seen, I'm sitting here in Dublin, and I can tell you that a lot of high street shops have closed down that you thought would never close down, probably because of the working from home piece more than anything else, which I think is interesting. But I think that's consistent with what we've seen across Europe in the high street. This working from home and no office workers in the down core has been an unbelievable challenge for them, irrespective of government supports for them or not.
Yeah.
And in addition to that, Andrew, sorry,
go ahead, Marlene.
To Brian's comments, it is of course the remote work that was mandatory, and it continues to be a trend, and also the reduction of flights and tourism that brings less people to the prime high street locations, and Lisbon, Paris, Madrid, London, and that contributed as well to an increase of the vacancy in high street. I don't have a number, and I don't want to guess. I would need to ask my colleagues from research. I could agree that there is an increase on the vacancy, but we are already seeing also the occupiers sector to be a little bit more dynamic, looking for flagship stores in prime high street locations, because retailers know that having a flagship store is very important to engage with their audience online and offline.
Yeah, no, you're absolutely right. Like the lack of tourism, we've offices in London, so I spend a fair bit of time there. The fact that you can walk up and down Regent Street or Oxford Street and have every shop to yourself is shocking, because there's just no tourists, right? And there's very few office workers.
Well, I can bring you an update, because Mark Espinette has just posted to us that according to their annual PMA audits across 27 major European cities, from Dublin to Warsaw, Stockholm to Rome, the vacancy is around 12% of units. So your guess was very good. Well done.
Well done, York.
Very good.
We were talking about dark stores and that sort of thing just a few minutes ago, Charles, and you were saying how these have sprung up. I've got a question from Heinrich Rushton. Have new or global players taken advantage of this pandemic situation to gain advantage and penetrate European markets? Now, we've also already talked about people like Gorilla and various others springing up. Have the panel seen any other new entrants into the European markets, or is it too early to say?
I can tell you, I've seen a couple of new, American entrants into the European market of late. They may have been pre-pandemic. I think the largest challenge is Marlene's point, is actually, how can they fly and see real estate? That's the real tricky part, right? And with all the quarantine issues that exist in different geographies throughout Europe, I think that's the biggest restriction, quite honestly, at the moment, for international capital trying to access Europe.
I can only agree, given our latest resources and conversations we had on a European level, that there's an increasing money coming from international investors into Europe and into the core countries.
Okay, there's another question, Charles, if I can just...
Please do, Andrew. Yeah.
This is, what is the panel's perspective for the outlook for outlet centres and their attractiveness? So discounted outlet centres, one of my wife's favourite topics.
Well, it is, of course, a bit of a niche market. I don't know who'd like to answer that. Marlene, I think you have a couple of in Portugal. You have a couple of outlet centres, but it's not a major sector, is it?
Yeah, correct, Charles. It's not a major sector. To be honest, in South Europe, we don't have a very mature outlet schemes. However, what we've been seeing in the past years is that lack of tourism has affected all the large schemes, and normally outlet centers are large schemes. And also outlet centers are anchored mainly by luxury retailers, with during the pandemic have put it high restrictions in expansion. Recovery has been slow. There's limited transactions. Well, I don't remember transactions in Europe in 2021. And the pipeline for 2022 is very limited.
So it's still very much a tourism-driven sector. Jörg, do you have much to do with the outlets? Outlet centers. Germany is quite a player in the outlet business, isn't it?
Yeah, and unfortunately not, because I strongly believe that this is a format which meets consumers' criteria for shopping very well. They have the opportunity to win some bargain via the pricing, and they have the opportunity to buy quality in terms of brands and luxury brands. So this is pretty much a match for the consumer orientation. However, I believe we have only 10 outlet centers all across Germany.
But it is very much a niche sector.
Yeah, very much. And it's very restrictive. Yeah. It's very restrictive. Yeah. We've just today, I think it was released that an outlet center in North Rhine-Westphalia hasn't been permitted. So it goes to the next step of the legal lawsuit with respect to this development. I'm always, if I talk about outlet centers, it always comes to my mind the American formats of these kind of retail.
Let's not get too deep into outlets, because it is a very small segment, and for most of our audience today, it's too specialized. I'd like to instead talk about the omni-channel strategies of companies. We're already starting to see, for example, while the bricks and mortar retail has been losing out to e-commerce, we're seeing in some cases the arrival of a new group of investors being the e-commerce companies themselves, who are buying bricks and mortar assets in the shopping centers and on the high street. Is this a trend we're likely to see more of in 2022? Open to anybody to answer that. Brian, is this something that ever interests Slate?
Yeah, it does. I mean,
we've seen big companies in Germany like Miele, the washing machine company, moving online, buying assets in shopping centers where they didn't have any before. Zalando, Mr. Specs, these are all online specialists who are now looking. Amazon with their own downtown stores. How significant is this? A significant trend?
Well, I can tell you about it from when I think about our business, e-commerce, online sales generally. If you want me to comment on that, I can. So I mean, look, I think internet penetration is different in different markets across Europe. So, for example, we've been relatively unaffected by it in Germany. We've been definitely affected by it in the UK, but not necessarily in a bad way. So online shopping, the penetration particularly has increased. There's no doubt during the pandemic in the UK. Like Sainsbury's digital business grew; it doubled in size during COVID. Right. So right. And e-commerce, I'd say, in grocery has proven to be pretty sticky amongst consumers. But I come back to the point I always make is whether it's click and collect, home delivery, or in store, it's coming from that location. It's coming from the end of the spoke rather than the hub. So that's why I always think the locations of the assets that we own are critical in terms of that's where it's going to come from, regardless of how it's purchased. And what we found is from speaking to our tenants, which we do every day, they're kind of, I I would say, it doesn't really matter how. It doesn't really matter. They just think about their sales. Are they getting the products? Are they selling the products? That's how they think about it. How they do it. They're not, once they hit the numbers, they're happy enough. But I just go back to it. Really, it's all about that location. Again, if it's online, in store, or click and collect, it's coming from that location. So that's really how I think about it. In terms of online and convenient. It's an expensive business. So it's really in terms of moving that last mile is extremely expensive, as everyone on this call knows. So having that location close into rooftops is really critical in what we do.
Very good. Andrew, we have more questions.
Yes. So there's Thomas Bale has emailed, posted a question about the definition, because I brought it up and you brought it up. What do we actually count Flink and Gorilla as, retail or logistics last mile? And I think we talked earlier about the sort of merging of yields and that within these sectors. And do we see a sort of merger of the last mile logistics and retail sectors?
Well, I think it's a good point, because Brian, a number of things that you've said suggested that it's now no longer always as super clearly defined what is retail, right? So, I mean, the way it seems to me that the way you've been expanding is taking a somewhat watery view of what exactly retail is, and tell us something about how you view that.
Yeah, I suppose we just think about, we want to be at that last mile of distribution. We feel that food, if we just talk about grocery, but like the grocery business is a distribution business. It really is. So I really go back again to that end of the spoke. It like, if you take Amazon, for example, if you look at Amazon's accounts 12 years ago, and you look at the number of fulfillment centers they had, for example, and they publish this. And then if you look at the number of fulfillment centers they have in last year's accounts, they've quadrupled the number of fulfillment centers. That's one. Two, the distance from the end user in those fulfillment centers has gone from 100 kilometers on average to 20 kilometers. And why I'm saying that is they're understanding that distributing from close in, having your real estate closer in to where the end user lives, that's the key. Like 55% of the cost of the supply chain is in that last piece, is actually in distributing the product to the end user. So it's absolutely critical. If you're putting men in vans and distributing, it's critical that they're not driving 100 kilometers, but that they're driving as least as possible, because that's the most expensive piece. So really, that's where I think about, it's a distribution business more than retail. It's that to me is extremely different to
and a distribution of anything that consumer might need. So, for example,
anything.
A courier pickup point, or charging his car, or something like that.
Yeah. But I mean, if you think about then whether if it's medical supplies, pharmacy, or food, it's perishable. So allied with the cost, you have the perishable nature and the time. And the thing is, people, when they're ordering online, they're not going to wait 2 days. They usually want it today, or at the latest tomorrow. Again, it just comes back to that. It's about limiting that. It's about limiting that time and shortening the distance from where it's ordered, where it gets picked up and where it gets delivered. That's the key. Amazon have copped onto that. But so if I think about our stores in Germany, we have a distribution network. They just happen to be anchored with grocery stores.
It's a very, very key point, I think. Very key point, the definition of retail.
Yeah.
Andrew, other questions?
Yeah. So we've got one going back to yield compression. This is from Stefan. Given the massive yield compression in grocery-anchored and necessity-based real estate in Germany over the last year, and he says the latest supermarket deal at around 3.7% yield, do you think we are approaching the peak of the market, especially given rising inflation and interest rates? And do you expect the players active in Germany will expand into other European countries where yields are still higher?
We are seeing that capital is expanding into other countries, into Marlene's countries, where they can achieve a better yield. However, at the moment, the yields have come down to almost 3%. We have seen a single asset transaction in the southern part of Germany, which was a grocery anchored smaller asset, which has been traded around 3.1%. So the yield is much lower at the moment, and that's the clear indication where the market goes this year. But this is driven by the entire capital pressure of investors to invest into core retail, and core retail is only grocery anchored.
Well, Marlene, is Marlene seeing? It's an interesting point. Is Marlene seeing, for example, are you seeing in other markets outside of Germany? Are you seeing a dissipation of assets into other markets that might have gone into Germany but are now finding that Germany is perhaps fully priced?
For sure, Charles. We've been seeing that on the past years into retail, and more recently also on logistics. That I have to highlight, they go hand by hand, retail and logistics, and totally agree with Brian when we're saying is more the distribution, is part of the distribution channel, and very soon to be merged. We definitely see with yield compressions in Germany, France, even in Spain, some capital to shift towards Portugal, looking for that premium in more prime assets, supermarkets. We also see that into retail parks, which are also attracting some appetites as they also comply with the new trends of retail, as they also respond to retailers' needs in terms of low rental levels, large areas with ability to create stocks, and also they respond to customers' needs with their convenient location and easy to buy formats.
Great. One of the other advantages, if I may say so, Marlene, of having you here today is that one of the big names that has gone international in Europe has been the shopping center developer Sone Sierra, and this is a Portuguese company, and we're not generally used to that many Portuguese companies being so familiar in so many countries across Europe. I guess you follow them closely. Is there anything you can tell us, like how they're setting themselves up, how they're operating, how changes to their business model, that we can learn something about prospects for retail in this year and the coming years from how they're operating?
Good question, Charles. In fact, it is true. Sone Sierra is a leading company into the retail sector. They own and develop the best shopping centers, or at least part of the best shopping centers in Europe. They are present in Portugal, and Spain, and Colombia, in Italy. So very large experience managing shopping centers. And with Sone Sierra, we've been seeing the relevance and the attention that shopping center owners and asset managers need to have on their shopping centers to make them adapt to all the changes we've been discussing in the past hour. We have examples of shopping centers managed by Sone, where they deliver to all their retailers, they deliver and manage to their retailers during the pandemic a platform for those retailers that were not prepared for online sales. So Sone, very quickly, being the largest company in Portugal, they were able to create and deliver to their retailers in all shopping centers that platform. We're seeing shopping centers owned by Sone being redeveloped in terms of concept, creating experience food courts that you go to shopping centers, but it's the same to going to a Michelin star restaurant. And those type of experience are crucial nowadays for shopping centers to perform well. The examples we were saying to have different types of anchors in shopping centers. Leisure is something that we know for many years, but having, for example, a private hospital into a shopping center, or even or even public services inside shopping centers is driving footfall and making shopping centers own imagined by Sonai perform very well across the globe.
Very good, very good. Andrew, any questions, any further questions from our audience?
Well, I had one earlier, which was we touched on the repurposing of shopping centres, and there has been much comment and discussion about placemaking. And I wondered whether the panels could talk about good examples of placemaking, because clearly what may work in Lisbon may not work in central Dublin because of the climate, and the same with Hamburg, Jürgen. I just wondered whether there is any really good examples of placemaking which you have seen in different markets, which you could recommend or suggest could be followed elsewhere.
It's as I said or tried to mention before, it's the next big thing. So we are in Germany, we're not seeing so many examples so far. However, there are a few in progress at the moment, and one of these you're seeing behind myself, which is a former shopping center, and it is located in a very small town in the southern of Germany, and it was again just like the example we had in Berlin. It was a shopping center which nobody needed because the city was very well occupied by retailers in the city center in the pedestrian zone, and this is only a few meters away from the pedestrian zone, but it was clearly distressed. And we looked at it from several angles and tried to redevelop it into something else, but we didn't really came up with the right idea where everyone said, okay, let's go into that direction. And finally, we found out that this asset was located near a university, and we had a chat with the university about their demand in terms of space, and they were happy to speak with us because they needed 8,500 square meters of space. Hence, in this case, it's an example like Marlene already had given. We turned a shopping center into a university with a campus, and this is some kind of placemaking for this small town. This will come in a few years. It's underway. Currently, it's not existing yet, but this behind me is the model, which will be there in a few years' time. And my core sentence is placemaking is very different, and it really depends from location to location, what the particular needs of the customers are and what the municipality needs as well. It could be offices, residential, hospitality, as Melanie highlighted. So it's a very, very diverse situation, and it's very, very local driven. It's nothing where you can just pull out a blueprint and put it right over a certain area.
Marlene, have you seen anything in particular that you would highlight as a great example of?
Yes, Andrew, as I mentioned before, in Portugal, we have already successful examples of shopping centers repositioning. We do have a shopping center located in the surroundings of Lisbon, in the beautiful villa of Cascais. Used to be a shopping center anchored by a supermarket. The supermarket is still there, but the remain 18,000 square meters approximately were change of use for a private international school. It is a successful case because the shopping center or the asset is located in a villa that attracts a lot of foreign persons that live there and need to have or prefer to have their kids in international schools, and it is fully operating with success. We also have a good example in Spain, where not the entire shopping center, but if you look at the size of shopping centers in big cities, and especially to the size of their parking spaces, you now visit them and there's the feeling that probably we will not go back in time where the parking space is fully occupied yet. And this specific land and shopping center owner, Merlin, transformed the last floors into last mile units, and also space for Uber Eats bike to park, which is an issue in probably most of the major cities in Europe.
And Brian,
I think, Andrew, if I may say, the Germans have an expression, Handel ist Wandel, meaning basically that trade means constant change. Retail trade is something that's in constant flux. But I do think from what we're hearing here this afternoon it's never been truer, actually. Not only is Handel Wandel, it's a total redefinition in many instances of what classical retail always was. And that seems to be the take-home message for me today. Marlene's talking about entire conversions of shopping centres into bike depots and schools and hospitals and so on. And I think all landlords are having to look at their assets now in a way that they possibly never had to in the past, to see how they can make the most out of those. Just a little comment, by the way, on the side. Before I hand back to you, Andrew, Brian, can we expect Slate to continue at the pace that it was investing across Europe last year again in 2022?
Yeah, absolutely. So our team is growing. We've added 5 people to our team. We've just hired a global head of ESG who sits in London. We've hired an infrastructure person, taken on more analysts. We're going to set up offices in Oslo, adding to the team here in Dublin. So yeah, we're growing, and that's why I look about 20 years older than I actually am. But,
well, at the very mention of ESG there, to be very honest, Brian, I realize, probably if we were to be politically correct, we ought to have dedicated a little bit of time to talking about that. But I think most people have their own views on it, and there's not perhaps a great deal that we can actually say new today, other than we're all trying to come to grips with what it all means. But with an eye on the clock, Andrew, and I know we don't want to go too much over the allotted time, I would like to myself, unless you've got, have you another question?
No, I think you're right. The time is passing by, and I think we've overrun already. So.
Right. Well, sorry for overrunning, but I think it was a very interesting discussion, and I think we teased out quite a lot of stuff. As I said, I can see that this is. It would be hard, perhaps, to say there are little cherries to be picked out in 2022, but it's obvious that the entire retail sector is being scrutinized like never before. So, to all of you who are investing this year, Brian, with your expanded staff, I hope in a year's time we'll be able to look back and you'll say you were still able to buy well across the continent. We're very interested to hear what you actually did go ahead and do. And yeah. I'll thank you as well, Jörg and Marlene. Thank you very much for a very interesting conversation. I'll give back to you, Andrew. Thank you all. Thank you from my part very much indeed. Very interesting talk.
Thanks,
back
Charles.
to you, Andrew.
Thank you, Charles.
Thanks very much.
Yeah, can I also thank today's panelists, Marlene Tavar from JLL in Portugal, Brian Morris from Slate Management, who's in Dublin, and Yoki from Savills, who is in Hamburg. Should you wish to learn more about our future roundtable events, please follow our LinkedIn account, search for Targa Communications and REFIRE Online Roundtables, or visit our webpage, which is targacommunications.de/roundtables. And we look forward to welcoming you again next time. Until then, please stay safe, and I wish you all a very good evening. Thank you.
Bye-bye.
Thank you very much.
Thanks, Bye.
Bye.